Hey everyone, welcome back to another FinQuiz lecture. I know studying for the CFA Level 1 exam can feel like a massive grind, but you're doing great. Today we're covering the behavioral biases of individuals. And honestly, this is one of the most interesting and relatable topics in the entire curriculum because it's all about how our messy human brains actually work in the real world. This is about how people actually behave with money. And here's the funny thing. Most investors think they're rational. They're not. You and I, not fully rational either. And the exam loves that. So let's learn this module, folks. And as always, I'm going to explain it like we're sitting in a real classroom. Maybe you've got coffee in your hand and we're just talking finance in plain English. Now, if you've taken any standard econ or finance classes before, you know that traditional economic and financial theories typically assume a couple of big things. First, they assume that individuals are entirely rational. Second, they assume that markets are efficient. Basically, this traditional theory assumes that individuals make perfectly rational decisions using all the available information out there, which naturally leads them to the optimal outcome. And as a result of everyone acting like perfect calculating machines, the markets themselves are efficient. But let's be real for a second. Is that how you or I actually behave? Think about the last time you bought a stock just because your buddy at a barbecue swore it was going to the moon, or maybe you panic sold during a sudden market dip. We aren't robots. This is exactly where behavioral finance comes in. Behavioral finance actively challenges these traditional assumptions. It points out that when individuals face really complex decisions, like analyzing a crazy spreadsheet of financial data, they tend to just simplify the situation. Instead of processing every single variable, people often just rely on their basic judgment and personal preferences. So, in real life, when people face complex decisions, like choosing between Tesla, Apple, a bond fund, or holding cash, they don't sit there doing discounted cash flow models calmly. They simplify. They rely on shortcuts. They rely on emotions. They rely on memory. They rely on stories. That's where behavioral finance comes in. Behavioral finance challenges those traditional assumptions. It says, hey, humans are not perfectly rational, and markets reflect human behavior. And that's why this module is so important, because the CFA exam wants you to understand not just how markets should work, but how they actually work. Now, before we really get into the behavioral biases, just pause for a second and look at the screen. Notice how clean this is, how structured it feels, how your eyes just know where to go. That's not random. These are our FinQuiz battle-ready summaries. And let me tell you something, after helping thousands of candidates push through the CFA Level 1 exam, I've seen what works and what absolutely burns people out. Dense textbook paragraphs, they drain you, they blur together. And 2 weeks later, you barely remember what you read. But this layout is a lifesaver. When you're staring down the barrel of the CFA Level 1 exam, the last thing you want is to be flipping through 40 pages trying to kind of remember how overconfidence bias connects to illusion of control, or how emotional biases differ from cognitive ones. You need structure. You need visual hierarchy. You need something your brain can grab instantly. When concepts are mapped out side by side like this, your brain starts building connections automatically. On exam day, instead of thinking, wait, what was that bias again? You'll see the flowchart in your head. That's powerful. That's how recall works under pressure. And honestly, that's why we built these. If you want the complete set of battle-ready summaries for all learning modules, not just behavioral finance, they're available through the link in the description. They're a total game changer for CFA prep. So go check them out below. All right, let's get back to the good stuff. Now, the categorizations of behavioral biases. Here, We essentially split human irrationality into two main buckets: cognitive errors and emotional biases. Think of cognitive errors as basically a software glitch in your brain. It's just faulty cognitive reasoning. Maybe you processed a piece of news wrong, or your mental math is off. Cognitive errors are basically thinking mistakes. These are mental errors that come from faulty reasoning. Maybe we misinterpret statistics. Maybe we process information incorrectly. Maybe we rely on memory shortcuts that aren't accurate. It's like doing math with the wrong formula. The intention is good. The brain just misfires. For example, imagine an investor who believes a stock will keep rising just because it's gone up 5 days in a row. That's not emotion. That's flawed reasoning. That's pattern recognition gone wrong. So, folks, remember, if identified, cognitive errors can often be corrected or moderated. And I love that word, moderated, meaning if someone gives you better information, better education, or better advice, you can fix it. It's like someone saying, hey, you're using the wrong calculator setting. You go, oh, got it. Problem solved. So cognitive errors are usually fixable. Now, let's talk about the more dangerous category, emotional biases. Emotional biases are a different beast. These are not thinking errors. These are feeling-driven errors. These come from impulse, from intuition, from fear, from pride, from ego. This is when an investor says, I know the numbers say sell, but I just feel like it'll come back. That's not faulty reasoning. That's attachment. And here's the big difference the CFA exam wants you to understand. Emotional biases are much harder to correct. You can't just hand someone a spreadsheet and fix their ego. You can't give someone a lecture and remove their fear. These biases can usually only be adapted to, not eliminated. And this distinction is exam gold. Cognitive errors can be corrected or moderated. Emotional biases typically must be adapted to. Big difference, folks. Let me explain this in real-world terms. Imagine a client who hates realizing losses. They refuse to sell a losing stock because selling makes it feel real. You can show them charts, you can show them valuation metrics, you can explain opportunity cost, but if they are emotionally anchored, you may not eliminate that bias. Instead, you adapt. Maybe you design a portfolio structure that limits concentrated positions. Maybe you use rules-based rebalancing. Maybe you pre-commit to decision frameworks. That's adapting. Moderating a bias means recognizing it and taking steps to reduce or even eliminate it within the individual. So this is what you try with cognitive errors. Education works, information works, and data works. But adapting a bias means recognizing that the bias is part of the person and adjusting decisions around it. You accept it. Then you design strategy around it. That's usually emotional bias territory. Think of it like this. If someone doesn't understand statistics, you teach them. If someone is stubborn and overconfident, you manage around them. Huge difference. And I promise you, the CFA exam will test that nuance. They'll describe a situation and ask whether the advisor should correct the bias or adapt to it. And if you don't know the category, you'll guess. But we don't guess, we classify. Okay, so just remember, cognitive errors category, because it's fundamentally a logic error, cognitive errors are easier to correct than emotional biases. You just need better information or to be taught a better mental model. On the flip side, emotional biases. These are much, much tougher to deal with. Why? Because they stem from impulse or intuition. These are errors based on feelings and emotions. Because they are wired deeply into our human psychology, like fear and greed, they are difficult to correct. Imagine trying to tell a panicked investor not to be scared during a massive market crash. Good luck with that. All right, now we officially step into Cognitive errors. Now, this is where the CFA exam really starts testing whether you understand investor psychology at a deeper level. Remember, cognitive errors are thinking mistakes. These are not emotional reactions. These are flawed reasoning patterns. And the curriculum classifies cognitive errors into two broad buckets: belief perseverance, biases, and processing errors. Okay, so let's start with belief perseverance, because this one shows up everywhere in real life investing. Belief perseverance is basically our brain's stubborn mode. It's the tendency to cling to an initial belief even when new information contradicts it. And when that conflicting information creates discomfort, we experience what's called cognitive dissonance, that mental tension when facts don't line up with what we already know. Think about an investor who has been bullish on a company for years. Earnings start missing. Guidance weakens. Industry conditions change. But instead of updating the thesis, the investor says, "No, the market just doesn't get it." That's belief perseverance in action. The discomfort of admitting you were wrong feels worse than ignoring the evidence. This whole category is basically about stubbornness. Not emotional stubbornness, intellectual stubbornness. It's when the brain says, "I've already decided, don't confuse me with new facts." Now, within belief perseverance, the curriculum outlines 5 specific biases. Let's walk through them carefully because the CFA exam loves to test subtle differences. First is conservatism bias. This is the tendency to overweight prior beliefs and underweight new information. Investors react too slowly to new data because they're anchored to their previous forecast. Imagine an analyst who projected 10% growth for a company. New data clearly supports 3% growth going forward, but instead of adjusting fully, the analyst tweaks the forecast to 8%. That's conservatism bias. They're adjusting, but not enough. The consequence is slow reaction to information. Markets sometimes drift in one direction because investors collectively update too slowly. To overcome this, the curriculum emphasizes properly analyzing new information and assigning it appropriate weight. In practice, that means actively asking yourself, if I didn't already hold this belief, what would I conclude based on today's data? Now, in reality, you might have observed that financial market participants overweight their prior views and underweight new information. As a result, they react slowly, and sometimes markets drift gradually because everyone is updating too cautiously. On the exam, if you see an investor who is slow to react even after strong new evidence, think conservatism bias. The fix? Deliberately ask yourself, if I had no prior forecast, what would I conclude today? That question alone can save you from anchoring to outdated views. Look, in conservatism, investors cling to prior beliefs and underreact to new information. They don't ignore new data. They just don't fully incorporate it. Now, this one is everywhere. Confirmation bias is when investors seek information that supports their belief and conveniently ignore anything that contradicts it. You love a stock. So what do? You read bullish analyst reports. You follow optimistic commentary. You ignore the bearish research because those analysts just don't understand the company. Sound familiar? This bias makes investors focus only on confirmatory information. And here's where it gets dangerous. It leads to biased screening criteria. Investors design filters that automatically favor what they already like. The consequence? Under-diversified portfolios, overexposure, excessive optimism. So, a question in the exam might describe an investor who ignores negative earnings guidance but highlights positive product announcements. That's confirmation bias. How do you fight it? Force yourself to look for disconfirming evidence. Literally ask, what would prove me wrong? If you never ask that question, confirmation bias quietly grows. That single question can protect you on the CFA exam and in real portfolios. So remember a few things. Confirmation bias is extremely common. It's the tendency to seek information that confirms your existing view and ignore contradictory evidence. If you love a stock, you'll read bullish research reports, follow optimistic analysts on social media, and dismiss negative commentary as noise. The danger here is under-diversification and excessive exposure to favored investments. The curriculum even notes that confirmation bias can lead to biased screening criteria, where investors only look for stocks that fit their narrative. The solution is intentional discomfort. You must actively search for disconfirming evidence. Ask, what would prove me wrong? That single question can protect you on the CFA exam and in real portfolios. Then we have representativeness bias, and this one is about typecasting. It's when investors classify new information based on past experiences or labels. A company that performed well recently gets labeled a winner. A struggling company gets stamped a loser. And those labels stick. Within this bias, there are two key subtypes your CFA exam wants you to know, folks. Base rate neglect happens when investors ignore statistical probabilities and focus too heavily on recent data. For example, ignoring the overall industry failure rate and focusing only on a startup's recent growth. Sample size neglect is when investors treat a small sample as representative of the whole population. A stock outperformed for 3 years, so investors assume it will outperform forever. 3 years is not the entire universe of probability. This bias often causes overreaction to new information. Investors update beliefs based on simple classifications rather than deep analysis. On exam day, if someone is making a big conclusion from limited data, that's your signal. The cure? Slow down, gather more data, ask whether the classification truly reflects long-term statistical likelihood. And next up, illusion of control. This one is dangerous because it feels powerful. Illusion of control bias is when investors believe they can influence outcomes that are largely uncontrollable. They think skill can override uncertainty. You'll hear statements like, "I can time this perfectly," or "I have a feel for the market." This bias leads to excessive trading, higher confidence, and usually lower long-term performance. It also leads investors to overweight assets they think they understand deeply, like employer stock. So in the exam, you might see a question where the examiner might describe someone trading aggressively because they believe their forecasting ability is superior. That's illusion of control. The antidote? Remember that investing is probabilistic. You can improve your odds. You cannot eliminate uncertainty. If someone says they are certain about a market outcome, red flag. Okay, so the last belief, perseverance bias, is hindsight bias. Ah, yes. The I knew it all along bias. Hindsight bias is when investors overestimate how predictable an event was after it has already happened. The market crashes and suddenly everyone claims they saw it coming. A stock doubles and investors say, "It was obvious." No, it wasn't obvious. It feels obvious in retrospect. This bias causes unfair evaluation of managers and distorted self-assessment. Investors think their forecasting ability is stronger than it really is. The CFA exam might describe someone claiming their prior forecast was accurate, even though records show it wasn't. That's hindsight bias. The solution is simple but powerful. Keep written records of your forecasts and decisions. When you compare what you actually predicted versus what happened, reality has a way of humbling you. Now, step back for a second. Belief, perseverance, biases all share one theme. Once the mind forms a belief, it defends it. Conservatism adjusts too slowly. Confirmation searches for support. Representativeness labels too quickly. Illusion of control overestimates influence, and hindsight rewrites history. On the CFA Level 1 exam, you won't just memorize definitions. You'll need to identify which bias is operating in a scenario. And often they sound similar. That's why understanding the subtle differences is crucial. And remember from earlier, these are cognitive errors. That means they can often be moderated with better information, structured processes, and disciplined thinking. All right, now we move into the second category of cognitive errors, what the curriculum calls processing errors. Now, first, listen, folks. If belief perseverance biases were about stubborn beliefs, processing errors are about how our brain handles information in the first place. The information may actually be correct, but the way we interpret it becomes illogical or irrational when making financial decisions. So what the brain do is the brain try to simplify complex decisions, and sometimes it takes shortcuts that lead investors in the wrong direction. Now, these are the 4 major processing errors your CFA Institute wants you to recognize: anchoring and adjustment, mental accounting, framing bias, and availability bias. Let's walk through them one by one. Anchoring bias is one of the most common mistakes investors make. It happens when people rely too heavily on an initial piece of information called the anchor, and then make adjustments around that number. Once that first number enters the brain, it sticks. Let me give you a classic example. Imagine you bought a stock at $100. A year later, the company's fundamentals deteriorate and the stock drops to $65. Now, logically, the correct question should be, based on current fundamentals, what is this company worth today? But what does the investor actually think? I'll sell when it gets back to $100. That $100 purchase price has become the anchor. The investor is no longer analyzing the company objectively. They're psychologically tied to the original number. This happens everywhere in markets. Analysts anchor on previous forecasts. Investors anchor on past prices. Portfolio managers anchor on old valuation targets. The result is that people stay too close to their initial estimate, even when new information clearly suggests a different conclusion. So how do you overcome anchoring bias? The curriculum suggests something very simple but powerful. Objectively evaluate new information. Don't base investment decisions on past prices, previous forecasts, or historical market levels. Every decision should be based on current information and forward-looking fundamentals, not an old anchor floating around in your head. Now let's talk about one of the most interesting biases in behavioral finance: mental accounting. Mental accounting happens when people divide their money into separate mental buckets. Instead of treating money as one pool of capital, investors start labeling it. This is my retirement money. This is my vacation money. This is my bonus money. Or, this is my fun trading money. Economically speaking, money is fungible, meaning every dollar is interchangeable, but mentally, people treat those dollars very differently. Now, let's understand this concept with a simple example. Someone may invest their salary savings very conservatively in bonds, but then take their annual bonus and speculate aggressively in crypto or options. Same person, same financial goals, same risk capacity. But because the money came from a different source, the brain treats it differently. The problem is that mental accounting causes investors to ignore correlations between assets. They evaluate investments separately instead of looking at the overall portfolio. Now, such behavior often leads to inefficient portfolios and poor diversification. The curriculum also highlights another consequence. Investors treat income returns differently from capital appreciation. For example, preferring dividend stocks simply because they feel like income, even if the total return is lower. Now, what's the solution? The solution is to adopt a holistic portfolio view. Combine all assets on one spreadsheet and evaluate the entire portfolio together. Focus on total return, not whether the return came from dividends, interest, or price appreciation. Because at the end of the day, your portfolio doesn't care which mental bucket the money came from. Okay? Now we move into a bias that is extremely powerful in both investing and everyday decision making: framing bias. Framing bias occurs when people respond differently to the same information depending on how it is presented. The information hasn't changed, only the framing has. For example, imagine two investment opportunities. One presentation says, this strategy has a 70% probability of success. Another says, this strategy has a 30% probability of failure. Now, of course, both are mathematically identical statements, but psychologically, investors react differently. When outcomes are framed as gains, investors tend to become risk averse. When outcomes are framed as losses, investors suddenly become risk seeking. Now, folks, remember this bias is closely related to loss aversion, which we'll study later. Another form of framing bias is narrow framing, where investors evaluate decisions in isolation rather than in the context of the entire portfolio. For example, an investor might reject a small risky investment because it looks volatile on its own, even though within a diversified portfolio, it would actually improve overall risk-return characteristics. So the key lesson here is to look beyond the frame, ignore how the decision is presented, and evaluate the investment objectively based on future prospects. In investing, the framing can change, but the underlying economics does not. Finally, we have availability bias. Availability bias occurs when people overestimate the probability of events that are easy to recall or recently observed. Now, because the human brain is a little lazy sometimes, what this bias means is that we give too much weight to information that comes to mind quickly rather than information that is actually the most complete or the most reliable. So if something is easy to remember, dramatic, recent, or emotionally strong, we start treating it like it must be important. For example, imagine an investor watches two nonstop news stories about tech layoffs and suddenly thinks, okay, the whole tech sector is doomed. That's availability bias. He is not doing a full industry analysis. He is reacting to whatever is most visible in his mind. Or think about a retail investor who made great money once on Tesla, Nvidia, or Bitcoin, and now assumes that similar exciting stories will always work out. That's where the sources of this bias kick in. In simple terms, if something is fresh in your mind, you assume it's more likely to happen again. Let's say the stock market has been rising for 6 straight months. Investors start believing the market will keep rising because recent gains are easy to remember. And yeah, one very common example, it's human behavior. Suppose you keep seeing advertisements about a certain mutual fund because you see it everywhere. It feels familiar, and familiarity starts to feel like credibility. Now, remember these 4 sources of availability bias. First is retrievability, when people rely on ideas that are easiest to recall. retrievability means the information is easy to pull from memory. Second is categorization, when people classify new information using familiar mental categories, like saying, oh, this company is just another Amazon. Third is narrow experience, when decisions are based on a limited personal experience rather than broader data. We rely too much on our own limited history, like someone who started investing after 2020 and thinks markets always bounce back fast. And fourth one is resonance, when investors overweight outcomes that match their own beliefs or worldview. So if someone already loves real estate, every story about a housing boom feels like proof they were right all along. The big consequence is that we start focusing on only a few vivid points instead of the full picture. That is dangerous in investing because markets do not care what story was easiest for you to remember this morning. The result of availability bias is that investors often choose investments based on headlines, advertisements, or recent performance rather than deep research. This can lead to poor diversification and limited investment opportunities. So, what should an investor do? Slow down, do proper research, and look at longer-term historical data instead of getting hypnotized by whatever is trending on CNBC, Twitter, or your cousin's guaranteed stock tip at a family dinner. Because, just because something is memorable does not mean it is meaningful. So, guys, remember, the investment that shows up most often on your newsfeed is not necessarily the best investment. Okay, let's recap. Processing errors occur when investors process financial information in an irrational or illogical way, like anchoring ties decisions to initial numbers. Mental accounting divides money into artificial buckets. Framing? It changes decisions based on presentation. And availability bias overweights what is easiest to recall. These are cognitive shortcuts our brain uses to simplify complex decisions. And on the exam, you won't just memorize definitions. You'll be given scenarios and asked to identify which bias is influencing the investor's decision. Now, before we move into the next section on emotional biases, take another quick look at the flowchart on your screen. Notice how each bias connects clearly to its definition, consequences, and guidelines. That visual structure is exactly how we designed the FinQuiz battle-ready summaries. Instead of forcing you to memorize dense paragraphs from the textbook, everything is mapped out in a clean visual hierarchy that makes recall much easier during revision. When you're reviewing behavioral finance the week before the exam, this kind of structured layout makes a huge difference. You can see the relationships between biases instantly, which helps your brain remember them on exam day. If you want access to the complete set of these battle-ready summaries for all learning modules, you can purchase and download them using the link in the description below. They're specifically designed to help CFA candidates revise faster and retain more information when it really counts. All right, now let's move on to emotional biases, where things get even more interesting. Now, we're gonna learn a category that is honestly far more powerful than cognitive errors when it comes to real investors: emotional biases. Up to this point, we've mostly talked about thinking mistakes, cognitive shortcuts, faulty reasoning, information processing problems, but emotional biases are different. These don't come from bad calculations. They come from human feelings: fear, pride, attachment, regret, impatience. Now, as you've heard me mention before, and this is the key idea the exam wants you to remember, emotional biases are usually harder to correct. You can fix faulty logic with education, but fixing human emotion, that's a different story. Now, There are 6 major emotional biases investors exhibit: loss aversion, overconfidence, self-control bias, status quo bias, endowment bias, and regret aversion bias. If you understand how these show up in real life, the exam questions become much easier to recognize. Let's walk through them. Let's start with one of the most famous behavioral finance ideas: loss aversion. Human beings hate losses more than they enjoy gains. Psychologically, the pain of losing $1,000 feels much stronger than the happiness of gaining $1,000. Think about that for a second. If I offered you a gamble where you could win $1,000 or lose $1,000 with equal probability, most people would say no. The loss simply hurts more. This bias leads directly to something called the disposition effect, which you'll probably see on the CFA exam. The disposition effect describes the tendency for investors to hold losing stocks too long and sell winning stocks too quickly. Imagine someone bought a stock at $100 and it drops to $60. Instead of selling and reallocating capital to a better opportunity, the investor says, "I'll just wait until it gets back to $100. They're emotionally anchored to the idea of breaking even. At the same time, when a winning stock goes from $100 to $120, they quickly sell it to lock in profits because they're afraid the gain might disappear. So the investor ends up doing the exact opposite of what good investing suggests, cutting winners early and letting losers linger. The way to manage loss aversion is through discipline. A structured investment strategy and fundamental analysis help investors make decisions based on objective data rather than emotional reactions. Now let's talk about a bias that might be the most common one among investors: overconfidence. Overconfidence bias occurs when people overestimate their knowledge, their forecasting ability, or their skill in processing information. You see this everywhere in financial markets. Investors believe they can consistently beat the market. Traders believe they can time market moves perfectly. Analysts believe their forecasts are more accurate than everyone else's. In reality, markets are extremely competitive environments. But the human brain loves believing it has special insight. The curriculum actually splits overconfidence into 2 types. The first is prediction overconfidence, where investors believe their forecasts are very precise. They create narrow confidence intervals, meaning they think the range of possible outcomes is smaller than it actually is. The second is certainty overconfidence, where investors assign very high probabilities to their own predictions. For example, someone might say, "I'm 95% sure this stock will outperform." That level of certainty is usually unrealistic. Now, overconfidence becomes even stronger when combined with self-attribution bias. That's when investors credit their successes to skill, but blame their failures on external factors like bad luck or unexpected news. The result? Investors underestimate risk, overestimate expected returns, and often build poorly diversified portfolios. The best way to manage overconfidence is to review investment outcomes honestly. Investors should evaluate both successful and unsuccessful decisions and analyze what actually drove the results. Now, another thing, long-term performance measurement over multiple years also helps reduce the illusion of skill. Next, we have self-control bias, which has less to do with investing strategy and more to do with human behavior over time. Self-control bias refers to the tendency for people to prefer immediate consumption today rather than saving for the future. If that sounds familiar, it's because it shows up everywhere in life. People say they'll start saving next year. They'll start investing next month. They'll start budgeting next week. But present consumption always feels more attractive than future security. In behavioral finance, this tendency is closely related to something called hyperbolic discounting. That simply means people prefer smaller rewards today rather than larger rewards later. For example, many individuals will choose $100 today instead of $150 next year, even though the delayed reward is financially better. In investing, this leads to insufficient savings and sometimes excessive borrowing to finance current lifestyles. Later in life, when investors realize they haven't saved enough, they may take excessive investment risks trying to catch up. Now, the solution is structure. Investment plans, saving rules, and automatic contributions can help investors maintain discipline when emotions push them toward short-term gratification. Another emotional bias investors often exhibit is status quo bias. This is simply the tendency to prefer doing nothing instead of making a change. People get comfortable with their current situation. Even when evidence suggests a portfolio should be rebalanced or adjusted, many investors stick with the existing allocation. Why? Because change introduces uncertainty. Imagine someone built a portfolio 10 years ago and hasn't touched it since. Market conditions change. Personal circumstances change. Risk tolerance changes. But the investor avoids adjustments because the existing structure feels familiar. The danger here is that portfolios can drift away from appropriate risk levels or miss better opportunities. Now, overcoming status quo bias requires recognizing the benefits of diversification and periodically reviewing portfolio allocations to ensure they still match the investor's objectives. Now, let's talk about something very human: emotional attachment to things we own. Endowment bias occurs when investors value assets more highly simply because they own them. Think about how people treat personal possessions. If you try to sell your old car, you probably believe it's worth more than a buyer is willing to pay. The emotional attachment increases your perceived value. The same thing happens with investments. Investors often hold familiar assets, such as stocks they inherited or shares of their employer's company, even when those investments no longer make sense for their portfolio. Because they own the asset, they assign it a higher value than they would if they were evaluating it objectively. So what happens? Any guess? This bias leads to inappropriate asset allocation and failure to sell underperforming or overly concentrated investments. One practical guideline is that if you inherit an investment, treat it as if you received cash instead. Then ask yourself how you would allocate that cash based on your investment objectives. That simple thought experiment removes emotional attachment from the decision. Finally, we come to regret aversion bias, which is deeply tied to human psychology. Regret aversion occurs when investors avoid making decisions because they fear the regret associated with making the wrong choice. Interestingly, people often experience stronger regret from actions that fail than from opportunities they never pursued. So instead of making a decision and risking regret, investors sometimes do nothing. This leads to extremely conservative investment choices, or something called herding behavior, where investors simply follow what everyone else is doing. Why follow the crowd? Because if everyone loses money together, the emotional burden feels smaller. But if you make an independent decision and it goes wrong, the regret can feel intense. To counter regret aversion, investors must focus on the long-term benefits of diversification and rational portfolio construction. Good investment decisions should be based on risk-return trade-offs, not the fear of future regret. So stepping back, emotional biases arise from human feelings rather than faulty calculations. Loss aversion makes investors fear losses more than they value gains. Overconfidence inflates belief in one's forecasting ability. Self-control bias favors immediate gratification over future security. Status quo bias encourages investors to avoid change. Endowment bias creates emotional attachment to owned assets. And finally, the regret aversion pushes investors to avoid decisions entirely. Understanding these biases is incredibly important because real investors, clients, portfolio managers, even professionals, experience them all the time. And once you start noticing them, you'll realize behavioral finance isn't just theory. It's happening in markets every single day. All right, next we'll step back and look at how behavioral biases actually influence overall market behavior, including phenomena like momentum, bubbles, and market crashes. Now, let's wrap up this learning module with one of the most fascinating topics in the CFA Level 1 curriculum: how behavioral finance actually influences market behavior. Up to this point, we've been talking about individual biases, loss aversion, overconfidence, regret aversion, and so on. But now the natural question is, what happens when millions of investors with these biases interact in the market at the same time? Well, that's when markets start behaving in ways that traditional finance models don't always predict. And that's where the idea of market anomalies comes in. In traditional finance theory, especially under the efficient market hypothesis, prices are supposed to fully reflect all available information. In other words, markets should be efficient, rational, and pretty hard to beat consistently. But when researchers started examining real market data, they noticed something interesting. Certain patterns in returns kept showing up again and again. These patterns generated predictable returns that were different from zero, and they persisted across time. Those patterns are called market anomalies. In simple terms, a market anomaly is a situation where actual market behavior deviates from what efficient market theory would predict. Now, before we go too far, the CFA curriculum makes an important clarification. Not every strange return pattern qualifies as a true anomaly. Sometimes what looks like an anomaly is actually caused by something else. Maybe a flawed pricing model, maybe a statistical issue, or maybe a temporary market imbalance. For example, sometimes researchers find an anomaly simply because the asset pricing model they used was incorrect. If your model is wrong, your anomaly might disappear once you fix the model. Other times, anomalies appear because of statistical issues. Maybe the sample size was too small. Maybe survivorship bias crept in, meaning failed companies were excluded from the data. Or maybe the researcher simply engaged in data mining, searching through mountains of historical data until something unusual appeared. And then there are temporary disequilibria, short-term patterns that appear for a while but disappear once investors exploit them. You may have heard of things like the January effect, the weekend effect, or the turn of the year effect. These patterns sometimes show up in data for a few years, but once traders discover them, arbitrage tends to eliminate them. So the key idea here is that true anomalies are persistent and predictable. Among the most studied and persistent ones are momentum, bubbles and crashes, and the value versus growth effect. Now, let's walk through these one by one. Momentum is one of the most famous and widely studied anomalies in finance. Momentum simply means that assets that have performed well recently tend to continue performing well for a while, and assets that have performed poorly tend to continue performing poorly, at least in the short run. In the markets, it's the idea that the future is basically a mirror of the recent past. If a stock was a rock star yesterday, we convince ourselves it's going to be a superstar tomorrow. It's the trend is your friend mentality until it isn't. Empirical research shows that returns tend to be positively correlated in the short term, roughly up to about 2 years. So if a stock has been trending upward recently, it may keep rising for a period. But interestingly, in the long run, about 2 to 5 years, the pattern reverses. Returns become negatively correlated and prices tend to revert towards their long-term average. Now, if markets were perfectly efficient, this pattern should not exist. Prices should immediately adjust to new information. But why do we do this? Why aren't we more skeptical? Well, our brains are hardwired with some pretty funny glitches. So, behavioral biases help explain why momentum appears. Let's look at the big three from the slide. One major reason is availability bias, sometimes called the recency effect. Investors tend to give too much weight to recent events. If a stock has been rising recently, people start believing the rise will continue indefinitely. You can see this behavior all the time in financial media. A stock rallies for 6 months and suddenly every headline says the company is unstoppable. Think about companies like Tesla during certain periods or tech stocks during the AI rally. Investors start projecting recent performance into the future, even when fundamentals may not justify those expectations. This is just us being lazy thinkers. We overvalue the info that's top of mind. If you turn on CNBC and they're screaming about AI every 5 minutes, your brain goes, well, AI is the only thing that matters. You ignore the boring, stable stuff because the shiny new thing is right in front of your face. Now, another driver of momentum is hindsight bias. Once a trend becomes obvious, people start believing it was predictable all along. Investors say things like, of course, that stock was going to rise. It was obvious. But of course, it wasn't obvious beforehand. Now, loss aversion bias. This one is a doozy. We hate losing $100 way more than we enjoy winning $100. So when we see a trend moving, we jump in late because we're terrified of missing out. Or we hold onto a crashing stock way too long because admitting the momentum died is just too painful for our egos. Together, these behavioral biases push investors to chase trends, which reinforces the momentum effect. Now let's move to something even more dramatic: market bubbles and crashes. In finance, we have a saying: markets take the stairs up and the window down. That's basically the definition of bubbles and crashes. A bubble is this slow, intoxicating climb where everyone feels like a genius. A crash is the sudden, violent realization that maybe, just maybe, a company that sells digital cat pictures shouldn't be worth more than Ford. A market bubble occurs when asset prices rise rapidly to levels that are not justified by economic fundamentals. Prices keep climbing. Why? Because investors keep buying, often driven by excitement, speculation, and fear of missing out. Eventually, reality catches up and the bubble bursts. A market crash, on the other hand, is the opposite phenomenon: a rapid and significant drop in asset prices, usually driven by panic selling. Notice the slide says bubbles develop slowly compared to crashes. Why? Because greed takes time to marinate. It takes a while to convince your grandma and your Uber driver to start buying tech stocks. But fear is instant. Fear is a fire in a crowded theater. When the behavioral factors flip from I want to be rich to I don't want to be broke, everybody hits the exit at the same time. So the crash is the moment the market realizes that a digital cat has no fundamental utility compared to a company that builds the world's infrastructure. History is full of examples, like the dot-com bubble in the late 1990s is a classic case. Internet companies with no profits, sometimes no revenue, were trading at astronomical valuations simply because investors believed the internet would change everything overnight. And yes, the internet did transform the world. but not every dot-com startup deserved billion-dollar valuations. Then in 2000, the bubble burst. Tech stocks collapsed and trillions of dollars of market value disappeared. More recently, many analysts point to certain periods of the cryptocurrency boom or meme stock surges as examples where behavioral forces strongly influence prices. Interestingly, not all participation in bubbles is irrational. Some investors know a bubble exists, but they still participate because they don't know exactly when the bubble will burst. Others face limits to arbitrage. Maybe short selling is difficult, or there aren't good hedging instruments. Professional fund managers may also feel career pressure. Imagine you're managing a hedge fund while everyone else is making money in a booming market bubble. If you stay out, clients might pull their money. So some managers participate simply to avoid falling behind. So behavioral biases also amplify bubbles. Overconfidence causes investors to trade excessively and underestimate risks. This is the classic "I did my own research" trap. During a bubble, people read 3 tweets and a blog post and suddenly think they're experts on complex semiconductor supply chains. They confuse a rising tide for their own swimming ability. Confirmation bias leads them to ignore information that contradicts their optimistic view. If the stock goes up, you tell yourself it's because you're a brilliant visionary. If it goes down, well, that's just market manipulation or bad luck. You only listen to the YouTubers who agree with you. Self-attribution bias makes them credit their gains to skill instead of luck. Now, the hindsight bias we have already discussed earlier, and next we have the illusion of knowledge, which is the mistaken belief that we understand a complex system better than we actually do. This often happens when we confuse familiarity with expertise. And then there's regret aversion. Investors think, what if this keeps rising and I miss out? So they join the crowd. Now, this is the most dangerous one. Anchoring bias causes investors to hold on to outdated price expectations. At first, they underreact to negative information because they're anchored to previous prices. But eventually, panic selling accelerates and prices collapse. And during crashes, other biases take over. That's why crashes often look sudden. But in reality, the psychological pressure had been building for a while. So together, these biases create a certainty bubble. We think we saw the past coming, and we think we can steer the future. So guys, understanding them is the first step toward more objective, realistic thinking. Okay, now let's talk about another well-known anomaly. This is a classic clash of the titans in the investing world: value versus growth. Think of this like the difference between buying a reliable 5-year-old Toyota Camry, I'm talking value here, versus betting your life savings on a startup that promises to build flying cars. That's growth. Now, if you look at the historical data, and I mean decades of it, studies actually show that the boring value stocks tend to outperform the flashy growth stocks over the long haul. But if that's true, why isn't everyone a value investor? Because humans are crazy for a good story. We'd much rather tell our friends at a barbecue that we're invested in the future of energy than admit we own a company that makes cardboard boxes. Growth is exciting. Value is, well, it's a box company. The first psychological trap here is the halo effect. This happens when we take one thing we love about a company, maybe they make a phone you can't live without, and we transfer that good feeling to the stock price. We think, I love their product, so the stock must be a great buy. But in the CFA world, we know better. A great company can be a terrible investment if you pay a ridiculous price for it. Don't let a cool brand name blind you to the actual math. For example, suppose a company has impressive revenue growth. Investors might automatically assume it's also a great investment even if the stock price already reflects extremely optimistic expectations. That halo effect can cause growth stocks to become overvalued while boring value stocks are ignored. You can see this dynamic frequently in technology markets. Exciting new companies attract huge investor enthusiasm, while slower growing companies with solid cash flows receive less attention. Eventually, however, reality tends to correct excessive optimism. Now, there is overconfidence in predicting growth issue. As analysts, we love our spreadsheets. We build these beautiful models showing a company growing at 40% every year for a decade. Spoiler alert, that almost never happens. When we get too confident, we overvalue these growth stocks. Behavioral finance tells us this isn't just about taking a risk, it's mispricing. We're literally paying a premium for a future that's statistically unlikely to be as perfect as our Excel models suggest. And finally, there's the home bias. This is just us staying in our comfort zone. If you live in the US, your portfolio is probably loaded with domestic tech giants. If you're in Japan, it's probably full of Japanese automakers. We tell ourselves it's safer to invest in what we recognize, but really, we're just ignoring a whole world of opportunities because we're afraid of what's unfamiliar. It's like only eating at the same pizza shop every night because the menu across the street is in a different language. In investment world, home bias refers to the tendency of investors to allocate a disproportionately large portion of their portfolio to domestic stocks, companies located in their own country. From a purely rational perspective, this doesn't make much sense. Global diversification should help reduce risk and improve portfolio efficiency. But psychologically, investors feel more comfortable investing in companies they recognize. This familiarity creates a false sense of security, even though domestic stocks are not necessarily less risky. So, what's the big takeaway from this entire behavioral finance module? The key idea is simple but powerful. Investors are human, and humans bring psychology into the market. Fear, pride, regret, overconfidence, and emotional attachment all influence investment decisions. When millions of investors act under these psychological forces, markets can deviate from purely rational behavior. That's why momentum exists. That's why bubbles form. That's why crashes happen. Understanding behavioral finance doesn't mean markets are completely irrational, but it reminds us that prices are influenced not just by information, but also by human behavior. And for you as a CFA candidate, and eventually as an investment professional, recognizing these biases can be incredibly valuable. Because sometimes the biggest edge in investing isn't a complex model. Sometimes it's simply understanding how humans think. So remember this idea for the exam, and for your career as well. Markets move with numbers, but they're driven by people. Okay, that's it for today. Good luck, folks. See you in the next lecture.